Investing around the business cycle. So keeping in mind the secular outlook that we talked about for stocks, bonds, and commodities, and those are those very long-term 20-year plus periods, let's chunk it down to shorter time frames, the business cycle swing, which we would define as the 4 to 5 year ups and downs in the economy. And we think that's what makes Pring-Turner's disciplines a little bit unique in that we pay attention to the business cycle activity. We believe that financial markets are linked in a logical, rational, sequential relationship with business activity. And they've been following these business cycle sequences for over 150 years. So they often repeat. They're not always equal distance. They're not always the same length. But there is a pattern. And there's a pattern to the economy and then a pattern to the financial markets relationship to the economy. So in this first chart, the blue line is just a representation of the economy. That's production. That's the expansion, contraction of the economy. So when the house is built or a car is made, that's production in the economy and represented by that center blue line. Now we've all heard and know that the stock market is a leading indicator for the economy. And so as we draw in the red bell-shaped curve, you'll see that stocks tend to move ahead of the economy. They move up before the economy comes out of recession, and they move down before the economy heads back into recession. If you think back to the last major stock market low, happened in March of 2009. Well, the actual economic low happened in July of 2009. Of course, we didn't know it at the time. It took the Conference Board and economists a year or so after that to finally confirm that the economy had actually bottomed at that point. Nonetheless, the stock market led the economy, bottomed out months ahead of it, as it typically does. Finally, the third bell-shaped curve in this diagram is inflation and interest rates. They tend to lag the economy. So once the economy starts picking up steam, the demand for money picks up, the demand for raw materials picks up, inflation and interest rates tend to move higher only after the economy does well for a while. Also, as the economy slows down, inflation and interest rates lag. They end up coming down only after the economy has cooled off for a while. So keeping this simple bell-shaped curve sequence in mind is helpful in deciding whether or not within a 4 to 5 year business cycle an investor should be increasing exposure to the stock market, reducing exposure to the stock market, and likewise for bonds and inflation-sensitive assets like commodities or natural resource companies. Now we all know in the real world things just aren't that smooth. The bell-shaped curve looks pretty on paper. It's a good theory. How does it look in the real world? Well, in the real world, the chart looks something like this. A jumbled up economic Gordian knot. Lots of noise out in the economy. Reports every day that often contradict each other. And how can we take that noise and turn it into something useful? Well, if we were to unscramble this Gordian knot, what we find is that there is a sequence, that there is some rational, logical sequence to the whole economy. So if we unscramble it, we'll find that there are leading, coincident, and lagging pieces. So from the top left down to the bottom right, you'll see that the sequence, one indicator leads the other. In this case, these are smooth momentum of money supply, and you'll see starting left to right, money supply will bottom, then the bond market prices will bottom or interest rates will start to go down. Eventually that will mean stock market will bottom, then the economy bottoms, and then finally inflation sensitive assets or commodities will bottom. Same is true in reverse. First money supply peaks, then bond prices peak, then the stock market, then the economy, and then finally inflation-sensitive commodities peak. That's the sequence. It's not perfect. It doesn't happen exactly every time. We've hyphenated the arrows that show things getting a little ahead of another asset or ahead of the sequence so that they get out of sequence or out of step once in a while. But generally you'll find that if you can follow the sequence, it's a helpful roadmap for where you are in the business cycle. And most importantly, what does that mean for investors? What can we anticipate will happen next? When's the next turning point? We don't want to extrapolate the past forever in the future. We know that there are going to be cyclical turns. By using this type of a roadmap, we're able to identify what the next step might be and when it might show up. So I hope you can appreciate that this type of information would be helpful in shaping your asset allocation decisions in your own portfolio. Now, Pring-Turner has organized the business cycle into the so-called 6 stages. And this was done because we're taking a look at what we call the 3 main food groups: stocks, bonds, and commodities. Since there's 3 main food groups, and there can either be a favorable or unfavorable period for them in the cycle. In other words, you'd either want to buy them or sell them at each point of the cycle. So 3 groups, 2 decisions, that makes for 6 turning points. So for instance, we start the cycle in recession on the left-hand side of the chart. That would be stage 1, where the economy is below the equilibrium line and shrinking. The first asset class to do well is the bond market, because interest rates will be coming down in recession. Next, stage 2, stock markets. Before the economy actually comes out of recession, will find their bottom. So stocks turn higher after interest rates have come down, and they start to anticipate the next recovery. Finally, as the economy picks up steam and comes out of recession, inflation-sensitive assets or commodities tend to bottom out and start to improve. So in stage 3, you have all 3 of the main food groups doing well, and the environment for them is good. Interest rates are low or have come down, stocks have turned up, and now commodity prices have turned up. Now as the economy picks up more and more steam, the demand for money picks up, interest rates pick up, inflation picks up, and so the first asset class to start to do poorly is the bond market. And so that would be a cyclical turning point for bonds in stage 4. Stocks and commodities can continue to do well, and bonds are the first to start underperforming. If interest rates go up high enough, stocks will start to feel the pressure. The economy will at some point slow down with enough increase in interest rates. So next, the stock market will smell out the next slowdown in the economy, and stocks peak out. So now in stage 5, you have both bonds and stocks in an unfavorable environment, but inflation-sensitive securities can still continue to do okay for a while longer. Finally, as the economy rolls over, the demand for raw materials goes down, prices for raw materials would go down, and that's the last category to have a sell signal. So now in stage 6, you have a period or a stage where all 3 asset classes are doing poorly. So you can see that using the 6-stage methodology as a guide in your asset allocation decisions, that you would make gradual shifts as you move through the 4 to 5 year business cycle. It's not all in or all out at any given time, but just to gradually shift weightings in the 3 asset classes depending on risk and reward opportunities revolving around the sequential movements of the business cycle. The next step that we would take is to decide which sectors of the stock market do well in each stage. For a long while, there's been plenty of research done on so-called early cycle, late cycle sector, the winners and losers. We've been able to take information going back to the 1950s for industry performance around the business cycle. And looking at performance through the 6 stages, you'll find that each stage has its groups that tend to outperform or underperform. Of course, every cycle is different. Some sectors may be in secular uptrends or downtrends, but generally these sectors tend to do well in the various stages, and at the bottom of the page you'll find the performers that are the worst performers in each stage. So again, the second part of the decision-making process involves not only what asset allocation to have around the cycle, but then which sectors do you want to emphasize around the cycle. Also, it's very helpful to know, well, what's next? What's the next stage that we can anticipate? What are the next groups to do well or poorly? How can we incorporate that into the business cycle framework and asset allocation decision making? So using the business cycle to change asset allocation and sector rotation within the business cycle seems to make sense. Up to now, it maybe sounds good in theory, and you might be wondering, well, does it work in the real world? And what we can announce is that in the year 2010, Dow Jones Indexes contacted Martin Pring at Pring Turner Capital to inquire about the 6-stage business cycle analysis he uses and the methodology. And they were able to spend time analyzing our barometer performance and stage data going all the way back to 1955. So after this very thorough backtesting, they found that the methodology indeed was successful and it did add value, and they wanted to construct an index based on the business cycle work. In fact, there is now a Dow Jones Pring U.S. Business Cycle Index based on the 6-stage model. The index is an actively managed index. In other words, it's not a static index. It changes as we move through the economy. And as the index changes, the asset allocation of the segments change, and also the sectors that are emphasized change within the 6 stages. So how did this index perform? Well, we have 2 different time periods, one going all the way back to 1955 and one back to 1994, which also includes a period where investors could have actually invested in each component of the index. And that performance since 1994 has shown about an 11% annualized rate of return, and importantly shows positive returns in each stage of the business cycle. Now, of course, we want to throw out the caveat that not every stage of every cycle had positive returns, but on average we had positive returns in each stage of the cycle. So despite economic contractions, slowdowns, recessions, the performance showed positive returns, and relative to each of the 3 asset classes, bonds, stocks, and commodities, the index did a nice job of outperforming, and also while taking less risk. The chart shows the comparison of the index to the 3 other investment classes. What you'll find is the returns on the index beat the 3 different asset classes, and also did it while taking about 2/3 of the risk of the stock market. So higher returns with less risk. That's the goal, and that's what's actually happened. So how did it do that? Well, again, it's by reducing exposure to certain asset classes during their declining periods in the business cycle, and then emphasizing the asset classes during their favorable times of the business cycle.